Yeah.
Yeah.
All right. So, good evening, everybody. And thank you so much for joining us tonight. We have a special guest, is the money guy. So if you want money, just ask Daniel. So Daniel, welcome.
Hey, thank you. Thank you, everybody, for joining. Thank you, Fanny, for hosting tonight. Really appreciate all your time and very excited to be here.
Thank you. Daniel, can you tell us about your background and your journey?
Yeah, so absolutely. So born and raised in Toronto, was never really good at school. I was my grades were always like the stock market. So I'll have some A's and B's and then some D's and F's. And yeah, I was all over the place. And then failed math many times. Math was my poorest subject. I failed, I think, grade 10 math. So math is not my forte. And then fast forward later, when I got to, I think it was 18 years old, I started working for one of the big 5 banks. so that was the funniest thing, right? So and so I was working for one of the big 5 banks. Eventually, we scaled up. I became a financial advisor, then a senior financial advisor. So I was working there for 8 years, and then after 8 years, I noticed that I couldn't really service my clients because we dealt with a lot of real estate investors, and we also dealt with a wide range of people, like first-time home buyers, debt consolidation clients, wide range. And what I noticed was that a lot of them were having a tough time getting financing at the local bank. And mind you, I was new into the game, but a common complaint I always heard was, I've been banking with you guys for 20 years, 30 years. How come you can't get me approved for a mortgage, right? And so the reason was because the banks always looks at what your current financial picture is at that time. So you could have been paying your mortgage on time for 20 years, paying it on time for 30 years, have a great job. But as soon as something changes in your financial picture, it doesn't matter how long term of a client you are. It doesn't matter how much money you made in the past. It doesn't matter how great your credit was in the past. If you mess up one thing that doesn't fit in their box, they're just going to say, you know what, I'm sorry, we can't give you money, right? And so I was facing the client all the time, and I'm always dealing with clients, and I see them as people, right? I see them as, hey, this is John, Jim, Sue, but upstairs, the guys with the big rubber stamps, they look at everybody as black and white, just numbers, right? And does the deal fit? Does the deal not fit, right? And if it doesn't fit in the box, they're just gonna say, sorry, we're not giving you money. And you're not approved for your dream home. You're not approved for your refinance. You're not approved for your debt consolidation. You're just not approved, that's it. And it's one thing to tell a client, especially a long-term client, that they're not approved, they don't qualify. That's one thing, right? And I understand every business has their box, but it's another thing when you cannot provide the solution, right? So if it doesn't fit in your box, we were not able to show them the way or direct them to another channel that can get them the money, because that would be considered a conflict of interest, or we're sending business to our competitors, right? So after a few years of seeing people in front of my face getting declined, when I understood that, wow, this deal actually makes sense. I can't understand why these guys upstairs are declining the deal. They would actually go to a mortgage broker, and then 2 weeks later, the mortgage broker would get the deal approved in the same bank. And I would still see the client, and the client would be like, Daniel, why couldn't you approve the deal? But then I go to a third party, a broker, and the broker got the deal done at your bank. And I said, wow, this is interesting. So
why?
You know, right? So that's where I really learned about repackaging deals, because at that time, we take things as face value, right? The client will tell me, this is how much I make, this is my credit, this is my liabilities, this is what I'm trying to do, I'm trying to buy this house, or I'm trying to get financing for whatever. And we were basically order takers, right? The client gives us the information, we send it up, and that's it. So I said, there's got to be a better way. And that's when I jumped ship and I became a mortgage agent. And that's when my mind exploded. I didn't even realize, because after working at the bank for 8 years, I thought that when I say no, or when upstairs says no, you're done. You can't get money anymore. When I became a mortgage agent, I realized there's actually different channels of money, right? There's multiple channels for financing, and other channels that are open to self-employed income. They're okay with self-employed income. They're okay with cash income. They're okay with bruised credit. They're okay with foreign income, right? And I was like, holy smokes, like, is this for real? And then later on, I discovered that there's actually lenders out there that will lend money with no income at all, with bad credit. Like I'm talking about bad credit as in bankruptcy, okay? So then I started to learn the business more and more and more, and repackage deals. So that's basically what I do today. I finance people, I finance my clients. I can direct them to all three channels of financing. That's the A financing, that's the B financing, and the C financing. So no matter what your situation is, there is a lender out there for you, and that's all we have to do, fit their specific boxes. So that's a little bit about me.
Yeah, but can you tell us why the bank will say no to you, but when a mortgage broker comes with exactly the same request, they say yes?
Yeah, so absolutely. So it's something called repackaging, right? And a client might come to us saying, hey, I make $100,000 and here's my car loan, here's my line of credit, here's my credit cards. And at the bank, sometimes what they'll do is they'll just take that information and throw it in the system. And when someone who makes $100,000 and they're trying to borrow, let's call it $500,000, that deal would work if there's no debt. But if you have $1,000 a month car payment, you got OSAP, you got credit cards, you got line of credit, the numbers don't really work anymore, right? So in the banks, they don't, I'm not saying this is with all, but most advisors don't know how to repackage debt. And what I mean by repackaging debt is if a client has a big line of credit that's not utilized, and they have, let's say, 5 credit cards that are maxed out, the numbers actually look worse when you have multiple debts on different trade lines. So what we can do is actually just tell the client to draw like 30 grand off their line of credit and pay off those credit cards. So it looks like one debt. Just by doing something so simple, just like that, actually brings down the numbers. So that could be the difference of not being approved versus being approved. That's one strategy. Another strategy is the car loans. Car loans are like the number one killers of getting mortgage approved, because we all love driving nice fancy cars, right? And the cheapest car payment I think is like $300. They go up to $1,000. I see people that pay almost $2,000 a month for car payment, right? It's almost like a mortgage payment. So if you have to subsidize a car payment plus all your liabilities, it becomes really tough. So on the broker channel, we found special ways to actually get rid of the car payment altogether, right? So there's different strategies we can mitigate. So we can actually have a client sell their car and then re-borrow that money back after closing. So that what happens is when we send the deal to the bank, there's no debt. So the client qualifies. Once we close the deal, we throw on the new car loan after, because the thing about it is getting mortgage approved is actually really tough. Getting a credit card is easy. Getting a line of credit is easy. Getting a car loan is easy, right? So what you want to do is eliminate all the excess debt and get the easy mortgage approval first, and then you can add on all the stuff later after closing, because it's very easy to apply after. So basically on the mortgage broker channel, we can find ways to repackage debt and make a deal go through, whereas traditionally with the banks, they're just going to look at it and say, no, it's not going to fly.
I think we have one question. He said, hello, can you read it?
Oh, yeah. So, okay. So Dre's asked about CMHC's GDS, TDS. Okay. So CMHC is only for the A channel, right? They're not going to go to the B or the C. So CMHC is the Canadian Mortgage Housing Corporation, and it's basically for when you're putting less than 20% down payment on a purchase. So when you put less than 20% down payment, you have to pay insurance, and that insurance is not for you. It doesn't protect you. It doesn't protect your family. It protects the bank, basically. So it's a guaranteed loan or guaranteed interest that the bank gets. So I always advise that if it's possible, put 20% down payment so you can avoid the fee altogether. Okay. And not only do you have to pay the fee, you also have to qualify in a shorter amortization schedule. So if you put 20% down payment, you can actually get the maximum mortgage loan, which is 30 years. If you put less than 20%, it goes to 25 years. So it gets tougher to qualify. And just to make it, like, how do I say it? The easiest way I can say it is, if you put less than 20% down payment, you have to report a much higher income to qualify for the loan. Yeah. Tracy Mighty. Okay, so Tracy, so that's a really great strategy. So so basically what Tracy's asking is, if you have a car loan, how do you get rid of it and then add it back? So one thing you have to do is, we do this on the back end, but what we'll do is we'll sell the car, right? You have to have equity in the car first. So if you're negative equity, it's just not going to work. But what you can do is you can sell the car and then refinance your car and have that already set up, have the deal set up. But you have the deal set up after closing of your mortgage. So you close your home, you get your keys first, and then after you get your car loan right after.
Okay, Danny, I wanted to ask you. So you said if you have, let's say you have like 6 credit cards, let's say for a total of 30,000. So it's better to take one line of credit of 30,000, pay off this, but you have only one, even though it's the same amount.
Yeah, it looks better. It looks better. Because what happens is the banks don't only just look at the numbers, they look at the story as well, right? And let's say if you have multiple credit cards that are right up to the limit, it's maxed out, it tells us stories. It says that you're not handling the debt very well, right? And credit cards are usually at 20% interest. So that means that if you got 5 credit cards at 10 grand, that's $50,000 maxed out at 20%. That's a bad story. But if you got a line of credit of $50,000 at 7%, it looks better, right? Because credit cards are not meant for you to hold a balance. Credit cards are used for transaction uses. It's for money in, money out, and you got like 22 days with no interest. So you want to buy a TV, you want to buy renovation materials, whatever. You use the bank's money today. You don't have to pay anything for about 22 days with no interest. That's what the premise of a credit card is for. Now, if you need to hold a balance, you would put it on a line of credit. You don't hold a balance on a credit card. That's the wrong tool, right? So there's multiple tools when it comes to credit. You've got credit cards that's unsecured, then you have credit cards that are secured, then you got line of credit that's unsecured, secured line of credit, then you got mortgage, then you got loans, and then you got mortgages, right? So when it's unsecured, it's the most expensive and it's the easiest debt that you can acquire, right? When it's secured, it gets a little tougher because you need that asset. You have to qualify for that asset. That's number one. Number two is the interest rate is usually lower when it's a secured property because the bank has something to take back if you don't pay, right? But in terms of building credit, you want to go unsecured all the way. So for your viewers, if you're trying to buy real estate, no money down, you want to build your credit, get an unsecured credit card, unsecured. Yes, it's 20% interest, but if you're using it properly, you're not going to pay that 20% interest, right? What you want to do is use it as many times as you can, pay it off, and build that credit, right? Because when it's unsecured, it's all about trust. The bank can't come after your house if you don't pay your unsecured credit card. All they can do is damage your credit rating. That's it, right? And that's why you build credit faster with an unsecured credit card, because it's all about trust. We don't know if you're going to pay us back, right? That's what the bank's saying. But if you pay us back, your trustworthiness goes up, so we're going to give you more money. When it's secured to your house or your car, hey, you don't pay, we know your address, we'll take this back, we'll take that back, right? So that's basically how it works.
Okay, we have another question. Can you read it loudly?
Yeah, so Grace is asking, how much can we expect to save if we're paying our mortgage bi-weekly instead of monthly? Okay, so if you're paying your mortgage bi-weekly instead of monthly, it's not that big of a difference. You got to pay it bi-weekly accelerated. That extra payment makes a big difference. And what happens is the interest is calculated, I believe it's daily compounded semi-annually with most mortgages. Some mortgages are compounded monthly. So what happens is when you take a 30-year mortgage and you, instead of paying it once a month and you're paying it every 2 weeks, you're shortening the time span that the bank is allowed to compound your interest. So you can actually save about 2.5 years on a 30-year mortgage, which brings me to the next point. Always take the longest amortization schedule available. Sometimes I get clients who they want to buy a property and they want the shortest amortization possible because they want to pay off the mortgage faster. They want a free and clear house, which makes sense. I get that. But most mortgages do have prepayment privileges where you can double up the payment. You can prepay the mortgage up to 15% or 20% with no penalties. And when you prepay your mortgage, it goes directly to your principal, right? So it's always advisable to take the maximum amortization so that your cash flow increases. So your monthly expenses reduces dramatically. And then what you can do is you can take advantage of those prepayment privileges. And the reason why I say that is because if you prepay your mortgage, if you have the ability to prepay your mortgage by 15 or 20% once a year, you can pay off your mortgage in 5 years. You don't need to shorten the amortization schedule. Just by prepaying your mortgage, you're going to pay it off a lot faster, right? But the problem is we can't predict what happens in life, right? A lot of times home buyers or investors, what they want to do is they analyze their financial situation today and they make a decision today and they sign a document today. But things can happen. You're signing a 5-year deal. Anything can happen tomorrow, next week, next year, 3 years from now. We don't know what's going to happen, right? So I would never take a shorter amortization because your monthly obligation is very high. So you want to stretch it out. You're able to do whatever you like. If you want to make a double up payment, it's up to you. If you don't, you make it the minimum payment. So I believe in flexibility more than paying the lowest rate or paying the least amount of interest, because in mortgage financing, in real estate, the mortgage rate is such a small, tiny component of the whole deal. And a lot of banks, a lot of mortgage brokers put a lot of emphasis on, hey, we're the cheapest. We got the lowest rates. If anybody who follows me or sees my content out there, I never talk about rates. I actually talk about paying a higher rate. Actually, right behind me is one of my presentations. I talk about if you pay a higher mortgage rate, you will actually make more money, right? And I'll be going through that in my training March 18th. I'll share that with you guys. But when it comes to financing and when it comes to purchasing a home or investment property, the mortgage rates or your cost of financing is so minuscule compared to the location of the property, the condition of the property, the crime rate of the property. Is there a school nearby? Is there a hospital nearby? Is there a police station nearby? Is there a highway nearby, right? What's your happiness factor? What's your commute like, right? So when you're buying a house or investment property, what you want to do is take away the or financing and look at the deal as a whole. Because every property that I bought with none of my money. I bought all my properties, no money down, and I even borrowed money. I borrowed money at 23% interest. My first property, I paid 23% interest. I bought it using credit cards, right? But at the end of the day, I profited $200,000 gross profit, right? So it's not about getting the lowest rate. It's all about how do you analyze the deal and get the best deal, overall deal.
We have another question from Amanda. Do you see it?
Hey, Amanda. So can you explain the difference between mortgages on home?
No. There was another one before. She say, being self-employed, what's the advice of getting a mortgage? Oh, you see that?
Oh, okay. So being self-employed, what's your advice for getting a mortgage versus a non? Okay. So I assume, Amanda, you're in the States, right? W-2?
Correct. I am in the States, but I'm on a I-9 as opposed to a W-2.
Okay, what is a W-2? I always hear that. What's a W-2?
It means that it's an independent contractor versus a hired employee where taxes are taken out on the employer side versus self-independently employed.
Got it. Okay.
By a company. Yeah.
Got it. Okay. So my advice, I'm not sure if it applies to the States. I'm pretty sure it does. But my advice, if you're self-employed, I'm self-employed, is to go through the B financing channel. Okay. The reason why is if you're trying to get financing through a traditional AAA bank as a self-employed individuals, the bank looks for 2 years of your notice of assessment and T1 general. So how do I say that for Americans? So they're looking for your net income that you're reporting to the IRS or the CRA for 2 years, okay? And how they look at that is if your income is going up on an uptrend, so we're in 2021, so if you show a higher income in 2020 versus 2019, so it's an uptrend, they will take an average, okay, of your net income. If it's going down, it's a downtrend, they'll just take the lower number. So the bank is already going to buffer your actual income. That's number one. Number two, you got to wait 2 years and you have to file for 2 years. So you're losing time. Number three, you have to report a high enough income and pay the taxes up front to qualify for whatever you're trying to purchase. So what I mean by that is if you're self-employed, it makes so much more sense to just go through the B financing channel, which is alternative financing, where you can get a mortgage in 3 months instead of 2 years, okay? And what they look for is business revenue. They want to make sure that your business is actually generating revenue, and you can provide that income through bank statements, proof of deposits, and invoices. Okay, so it's not your net income. And let me explain numbers and tax-wise what I mean. In Canada, if you report $100,000 income to the government, you're going to pay about $28,000, about $30,000 of taxes. Okay, and not only that, like if you're salaried, you're fine because you're already getting taxed at source, and then you can get a mortgage right away as a salaried employee. But if you're self-employed and you report $100,000, you got to pay 30 grand of taxes roughly, and you got to do that for 2 years. So you're going to pay about $60,000 of taxes. You're going to lose 2 years of getting into the market. All right, and the worst part is, whatever you're trying to purchase, within 2 years, your lifestyle would have changed, your life status would have changed, the market would have changed. And what I mean by this is, I got people right now in my system, I pre-approved, I think about 15 clients. 15 clients that I already pre-approved, and they're just having a tough time buying a house. Because when I pre-approved them in November, I said, guys, you're approved to buy $1 million house. Just buy it. Buy it now. I know it's not your dream home. I know like you want something better, but just get in the market right now because it's going to get crazy in January, February, March, right? Mm-hmm. And they didn't buy. They didn't buy a house. So guess what? Their income's still the same. They're making whatever they're making through their job. But now the same house that they were looking at went up 200 grand. Mm-hmm. So now they got priced out of the market, right? So I always look at time, number one, and also your taxes, number two. So when I did that deal for them, when I pre-approved them, the rates were about, I think, 1.89 for the rates. And they were complaining, well, Daniel, the rates are so high, 1.89. I'm like, oh my gosh, when my parents bought a house in the 80s, rates were like 18%. So 1.89 is a steal. Like inflation is 2% or more, right? So anything around 2%, it's technically free money. So yeah, so I would always look at your timing. I would look at your taxes and getting into the market ASAP, because you never want to miss that trend. I'd rather pay 5% interest, 6% interest, and see that $200,000 profit in my pocket. That's what I'd rather do, right? So being self-employed, what you want to do is maximize your write-offs, maximize everything, and just pay more. I hope that answered your question.
It did. And then I did have one other follow-up question about the differences between mortgages that are for a home that you live in versus taking mortgages for a home that is going to be an investment property.
Yeah, absolutely. So primary residence, that's the one that you're going to be living in. Mm-hmm. The rates are usually going to be lower, and it's easier for you to qualify. And the reason being is banks and lenders look at pride of ownership. When you put your own money, you put your own hard work in it, into the deal, you're living in it, you're going to tend to take care of that property, right? So they're going to analyze the deal differently than if you're putting a tenant in there. So usually when it's a rental property, you should expect about 0.25% increase on rate. And when we use rental income, a lot of people think that we can use the full rental income. It's not true. We can only use maybe 50% at a traditional bank, because there's expenses that the banks account for. So if you're buying a rental property and your tenant's going to be paying about $2,000 a month, which is 24 grand a year, expect to only add 50% of that to your current income. So that's 12 grand.
I see. Okay.
Hope that
Thanks.
helps. Yeah.
It did.
Yeah. A specific question from Victor. Do you see it?
B, lender financing for 3 months is usually. Oh, okay. So Victor, B financing. What I meant by the 3 months is that you can buy a property or get financing within 3 months of being self-employed. So what I mean by that is you can literally just start a company today, and then in 90 days, you could get financing. Oh, and that's what I meant. Whereas with a bank, if you start a business today, you have to file your taxes for 2 years. So we're talking about the timing on that. And typical B lender deals are usually for 1 year. The lowest rates right now, we're looking at 2.59, still very, very cheap. And you're expected to pay fees. So approximately 2% of whatever you borrow. So the bank's going to charge you 1%, and then the broker is going to charge you 1% of what you borrow. Okay, it's not what you buy. So if you buy $1 million property and you're only borrowing $500,000, you're not paying 20 grand. You're only paying 10 grand, right? So whatever the mortgage amount is, you're expected to pay 2% of that.
Oh, Daniel, can you explain the difference between A lender, B lender, and C lender?
Yeah, absolutely. So I got a chart here. Let me see. I'm reusing this chart from the capital raising boot camp. So let me show you. So you guys have a visual here. Let's see. Okay. So we got 3 channels. I'm not sure if you guys can see this. So we got 3 channels of financing. We got A, we got B, and we got C financing. And A financing is the cheapest. Ignore the crossouts. This is from an older presentation that we just did a couple of weeks ago. But so A financing is your typical bank, your typical credit union. And what you got to look out for is the banks, A and B, they underwrite you, the borrower. Okay, so they're gonna look at your criteria, your financial picture. With C lending, they're not underwriting you; they're underwriting the property. So let me go into that. So what do I mean by they're underwriting you, the lender? A lenders and B lenders, they're looking for something that I call the finance triangle. They're looking for your income, they're looking for your down payment, and they're looking for your credit. If you're missing these components, or you have problems with these components, they're gonna either say no altogether, or they'll say yes, but we're gonna charge you a higher rate. That's basically it. So A financing, the cheapest solution, your local bank. If you go through a mortgage broker, the mortgage broker 99.99% of the time will not charge you a fee because they get paid a commission from the bank, and the bank will not charge you a fee, and they'll give you the lowest rates. But it's usually the toughest lender to qualify for, right? Everything has to be pristine. B lenders are perfect for self-employed individuals, okay? So I'm in a B lender myself. I pay the 2% fee. I pay a higher rate. I can't even get the low rates that I get my clients, right? So B financing is perfect for self-employed. So if you're a roofer, you're a carpenter, you're a mechanic, you're a mortgage broker, realtor, who else? Truck drivers. This is for you, okay? So income that can fluctuate, or a lot of cash income, and they can even take bruised income, bruised credit. So if you miss a credit card bill here and there, that's okay, right? They'll still take you. These guys, if you miss a payment, they're gonna just say no, okay? These guys, they'll say yes. It's just gonna cost a little bit more. These guys, C lenders, it's private lending, okay? They don't care about your income. You could have lost your job. You could be new to Canada. Doesn't matter. You're gonna get the money. It's very expensive money, and it doesn't matter about your credit. What they care about is the property. So there's 5 things that they look for. They look for the location of the property. Is it in downtown Toronto, like a very good core where there's a lot of movement? Or are you out in the boonies, right? Where there's, I don't know, like 30 people as a population. You know, that's the next component, marketability. What are the chances they're going to get their money back? So with C lenders, the way they underwrite the deal is they're going to just assume that you're going to have problems with with repayment. So they're going to underwrite the deal with all the risk up front. Okay. What would happen if the borrower cannot pay? How fast can we get our money back? That's how these guys look at the deal. So location is very key. They're looking at the marketability. How fast can I get my money back if the client defaults? They're looking at the type of property. Is it a condo? Is it a townhouse? Is it a detached, semi-detached? What kind of property is it? They're looking at down payment, loan to value. So the minimum down payment is 20% down payment, okay? Whereas banks, you can buy a house with 5% down payment at the banks. You can't do that over here. So that's how they mitigate risk. And what was the last one? So we get location, condition, marketability. I forgot. It's been a long day.
It must be the how do you say? How the property is? Is it livable?
Yeah, that's condition.
The condition.
Yeah, that's condition. Let me just, I'm having a brain freeze right now. So we got loan to value, that's your down payment. We got the location, we got the condition of the house, the marketability, and then there's one more that I'm not remembering. Just give me a second. I'm just gonna pull it up, right? Liquidity, no, I think I did it. Oh, I did get it all. Yeah, I said everything. I'm just double guessing myself. Location, the property type, the property condition, and the loan to value and the marketability. So I did say all 5. So what I mean by condition is this move-in ready? Is it nicely renovated? Or does it look like a hoarder house and you gotta like bulldoze this place and remake it nice? So that's basically what these guys look at, right? So if you want to buy a property, no money down, or you're having tough time getting approved at these guys will finance you. So this is the fast money. Like this is where you make your moves. Like if you find a property that's like $50,000, $100,000 under market value, and you need to get that property, you go straight to these guys. Don't even bother with A or B, okay? Because you're gonna lose the deal altogether. So what you do is you borrow the expensive money right away, that property is yours. And then you bring it backwards. You take your time to bring it backwards. That's a strategy, right? And that's why I always tell my clients, stop looking at the rates. Stop looking at all that, because it doesn't mean anything. What you wanna do is you wanna look at the deal as a whole. Because if you can find a deal where you're gonna make 50 grand or $100,000 just by signing a piece of paper, who cares if you're paying 10% interest? Who cares? Because when you go through C lending, the rates are high. We're talking about like 6%, 7, 8, 9, 10%. Some are 15%, right? They're very expensive deals. But let's call it 10%, but it's 10% in a year. If you don't borrow the money for a year, you're not paying 10%. So that's one thing I really want to emphasize, right? So whatever you're signing the contract, your expensive money or your high rates are going to be for a year. The whole goal is to not hold this money for a year. The whole goal is to make 100 grand right now, make that $100,000 and acquire it and take your time to bring it back to cheaper financing. This is one thing I want to stress out. This is one point. This is my tagline. Let me see if I can find it here. The cost of financing comes from your profits, not your pockets. Okay? So this is what I've been always entrenching in my clients. Don't look at the rates. Don't look at the fees. What you want to do is look at the deal. Because if any of you have ever said these words, I wish I bought that property 15 years ago. You know that street, that house across the street, 15 years ago, I could have bought that house for $500,000. Last week, I just saw it sold for $2.5 million. Oh my God, I would be a multi-millionaire today. Okay? So never, ever look at the rates, never look at the fees. You want to look at the deal. because I have seen so many of my clients that their income stayed the same. Okay, they go to work. They're receptionists, they're secretaries, they work at Tim Hortons, they work at Starbucks, whatever. They're making 40,000, 50,000. Their income has stayed the same. Nothing has changed. Okay, but 15 years ago, they took the opportunity and they put the pen into the paper and they bought a property at 500,000. They paid, I don't know, 6% interest at the time. They paid heavy interest. But today they're retiring as millionaires, even though they still make 50 grand income, right? And who are they selling their houses to? Who are they selling their $2.5 million house to? They're selling their $2.5 million house to people who make $200,000 a year that didn't sign on the dotted line. You see what I'm saying? And the people who are buying the property at $2.5 million, they're borrowing money at 1.5 or 1.6. Yeah, they're getting the low rates, but they're paying $2.5 million. They're paying the previous owner's profits. So I always emphasize the cost of your financing comes out of your profits. It's not coming out of your pocket. So I never talk about rates. I never ever talk about rates. I'll go back to my first deal. Like this is my here. Let's go here. This is my first deal. 2014. I don't know if you guys can see this, but in 2014, I was a brand new mortgage agent. I told you guys about my story. I had no money. I had no savings. I had nothing. But an opportunity came across my table. $300,000 pre-construction condo. Okay, I had nothing. And at that time, $300,000 for a condo was very expensive, right? It looks cheap now, but at that time it was expensive. And people thought, my family, my friends, everybody said I was crazy. Daniel, you haven't even closed a single mortgage deal. You didn't even get a commission yet, and you're buying a $300,000 property. I'm like, you know what? I'll make it happen. I'll figure it out. One thing I did have was a credit card and a line of credit from working at the bank for many years. So what I did was I cash advanced my credit card, okay? I cash advanced it at 23%. Now, remember what I told you guys? It's 23% in a year. I'm not holding the debt for a year. I got an opportunity. I don't have money. I got to use somebody else's money. So I signed on the dotted line and the builder asked for $6,000 up front. I didn't have $6,000, but I had a credit card. So I swiped it, right? Actually, no, I didn't swipe it. I cashed advance. I had to cash advance. And those of you whoever's done a cash advance know that it's not 19.99%. It's actually 23% plus, I don't know, like a service charge. So that's what I did. I signed a condo with my now fiance, that time was girlfriend, and we didn't have money. And that's what we did. We bought it through a credit card. And the same strategy that I'm telling you guys, that's what I did. We bought it through a credit card at 23%. We had a line of credit, and we didn't want to hold a balance on the 23%. So we make a transaction right now, 23% interest. Right away, the next week, I pay it off with my line of credit at 7%. So if I hold the debt for a year, I'm paying 7%. But now I'm starting to close mortgages. I'm getting money. So now I'm paying down the interest. So I'm really not even paying 7%. But every time the builder says, hey, Daniel, I need $6,000. Boom, cash advance. Here you go. Boom, cash advance. Pay it down. Cash advance. Pay it down. Over time, in 2018, the condo was done. So we got to move in. And I said that I sold in 2018. I actually sold in 2019. So 2018, we moved in. We stayed for 1 year. And then 2019, we sold it. And we sold it for $500,000. So this is my first no money down deal. I bought a $300,000 property with none of my money. The down payment came from a credit card and a line of credit. And the mortgage came from the bank. And that's it. So that's how you do it. You use other people's money and you have to play around with debt. and whoever I sold the property to, I sold it for $500,000. I'm sure they got a good rate, 1 point whatever, but I made the 200 grand, right? So I don't care about rates. I'll borrow money at 50% if I'm going to make 100% return. It doesn't matter, right? Just like in stocks, traders, they don't care if the market goes up or down. If the market's going to go up, they're going to make money. If the market's going down, they're going to short the market and they're going to make money. It really doesn't matter where the market's going. So it's the same thing with me. I don't care how much the cost of the financing is. I care about having the access to money. That's what I care about. So right now I have $100,000 ready to go on line of credit and credit cards. So Fanny, if you say, hey, Daniel, I got an awesome deal. I'm going to show you how to make 100 grand just by signing on this dotted line. Boom. Tomorrow I'm going to go to the bank. I don't have the 100 grand in cash, but I have 100 grand in line of credit. So all I got to do is sign the deal. Boom, make my 100, right? And that's what I did. I did that. This property right now that I'm living in, I got the proceeds from there, shifted over here, and this is a no money down deal too. This property that I'm doing this interview with you guys, bought at this 1 month after this. I bought it for $340K. It's downtown Toronto. Put $16,000 of upgrades. Pre-COVID, it's worth about $720, right? And I was paying a 4% mortgage. So when I had clients that are telling me, hey, 1.89 is too expensive, I'm like, guys, I'm paying 4%, but I'm banking the $300,000, right? So that's what you want to do. You want to look at, how do I make my money? Don't look at oh my gosh, how much is it going to cost? Because at the end of the day, if we're talking about real estate investing, if you don't make a purchase, if you don't even invest, you're paying nothing. Okay? Like if you don't even sign on the dotted line, and if you're still renting, don't worry, you're paying 0% financing. You're paying rent. You're paying rent, right? But if you're a homeowner and you're trying to buy a property, you're trying to buy another property, and you're looking at rates over here, don't be like my other clients who are pre-approved and the property value went up 200 grand and now you're out of the market altogether, right? So that's one thing I always emphasize, always. I can't talk about it enough. Everybody borrows money. The richest people borrow money. Warren Buffett, Mark Zuckerberg, everybody who has money, they borrow money, because at the end of the day, the interest gets written off. Okay, you can write that off on your taxes. And another thing is, when it comes to rental properties, it's not even you paying, it's your tenant, right? So if you got a rental income, it's not really you paying out of your pocket every month. It's your tenant that's covering your rent. So yeah, that was my 10-minute ramble there. I'm very passionate on this, so yeah. I can go on forever.
Yeah, okay. Jean-Luc is asking, like, somebody who's starting out, just brand new and wants to buy his first property,
yeah,
and doesn't have a big income, what would you suggest for him?
If you don't have a big income and you want to buy a first property, I would, first of all, if you have debt, I would get rid of any debt first. Okay, so there's good debt and there's bad debt. All the debt I'm taking on right now, this is good debt. Okay, so I could take $200,000, $300,000 of good debt. If you have debt on credit cards at 20% because you bought a TV or you bought nice rims for your car, that's bad debt. Okay, so the first thing I would do is get rid of all the bad debt first. Okay, because when I was working at the bank, we were always taught to tell clients to save money. Saving money, it's a scam, all right? Because what happens is when you save money, you put your money in the bank account, the bank takes that money and they lend it out, all right? So you're making no interest on your checking account, and on your savings account, you're lucky to even make 1%. So when you're saving money, the bank is lending it out already at 20% on credit cards. So they're really making money on your money. So I wouldn't even bother saving money. If you have credit card debts, I would take all the money that I'm making to pay down that debt. Because if you are paying 20% interest, paying that 20% off, that's already a 20% return on your investment. That's an automatic return. That's number one. I would pay down my debt. After we pay down the debt, that's when I would start increasing my income and look for joint venture partners. You could actually do this all at the same time. Like there's 24 hours in a day. You could go to work, pay down your debt, make some phone calls, look for partners, right? But if my income is lower, just like when I did this deal, I had no income. So if you're employed, you're making 40,000, you're making 50,000, that is technically low or middle class income. Remember, when I started out, I had zero income. I was commissioned and I had no sales. So don't worry, look for the deal, make phone calls. You got to make contacts, talk to people, talk to realtors. And what I would do is talk to realtors that are investment focused realtors, because there's two different types of investors. Two different types of realtors. There's the realtor that says, hey, I'll help you buy your dream home, right? And there's realtors that says, hey, let me show you a cash flow positive property that's under market or has potential, a lot of upside potential, okay? So if your income is smaller, I would really hunt down the realtors that are investment focused. I wouldn't look for buy your dream home, because when you're trying to buy your dream home, you're actually going into a bidding war market, right? You're buying a finished product that is nicely done, and it's an emotional decision. When you're buying an investment property, it's all about the numbers, okay? It doesn't lie. I don't care if it has nice granite countertops, marble floors. If it doesn't cash flow, if I can't buy it under market value, then it doesn't matter. It doesn't matter. The numbers don't work. So when you're talking to a realtor, make sure that they present a deal, right? So it's like, that's how I found this deal. My realtor said, hey, Daniel, I got a deal over here. Based on the statistics of how many people are coming to Canada, number one, in 2014, what's the target immigration rate? How many people are coming to Toronto? Never mind Canada. How many people are coming to Toronto? What's the current population, the natural population? What's happening? There's another thing called Places to Grow Act. The government signed a deal called Places to Grow, and it's all about intensifying the major cities. And that's why when you drive on the highway, you might see a sign saying entering the green belt, right? And when you see that, that means that you can't develop that area. So a developer cannot just buy that piece of land and start building. So that means that there's less land to build on, right? So whatever is there is there. That's it. So giving all that data, I said, wow, that's a great opportunity. So I didn't really look at the focus of I was not making any money. I didn't look at the focus that I didn't have money. What I did was I looked for the deal, because at the end of the day, if you have a good deal, the money will show up. Okay? That's one thing I really want to drive home, because banks and lenders, they're in the business of lending money. So they're looking for good deals. So banks are looking for deals that the client has good income, good credit, good down payment. And then B lenders are looking for self-employed. C lenders are looking for just equity, good properties, right? So there's always going to be a lender out there for you. So if the deal is good, the lender will show up, right? And then at the same time, if there's no lender, that means that your deal is probably at 50% capacity, like out of 100, it's at 50% range. You might need to take on a partner now, right? So eventually you can find a different investor to come join the deal with you and make it 100% and make it a good deal. So I'm always looking for good deals. So I've never passed on a good deal. If a deal's good, we're gonna lend on it, right? If you ever hear someone say, no, we're not lending on it, that's probably because there's a problem with the deal. Hope that helps. We got Dre. How do you refinance a house that you lived in for 4 years to buy investment property? So that's a no money down deal. I like that. And how do you know if you have enough equity? Okay, so the magic number is 80%. Okay, the magic number is 80%. So what you got to do is you have to find out what the market value of your property is. So let's use simple numbers. Let's say you bought your property at $500,000, I don't know, 5 years ago. And today it's worth $1 million, okay? So it went up 500,000. The maximum loan you can get is $800,000 on a refinance. So the banks, any lender will give you maximum 80% of whatever the value is. So now what you got to do is now you know the top line. That's the maximum you can take out of the deal. Now the next step is you got to find out how much can you qualify for through your income. Okay, so the no money down deal that you're referring to is you bought a house, over time that house went up and you got all this equity. You want to pull that money out, and when you pull that money out, you're going to use that money as a down payment for the next property. And then when you do that, you're going to get a mortgage on that next property. Okay, so that's a true no money down deal. So the component is you have to be able to handle the debt load of the new property that you're financing and also the new refinance amount. How do you know if you have enough equity? So you got to do an appraisal. Yeah, but if you bought your property at least 4 or 5 years ago, guaranteed you have that equity. You're going to have equity. So you just take it out. So the reason why the condo market's been hot in the last few years is because people's income have been stagnated, right? So if you make 50 grand 6 years ago, you're probably making 50 grand today, but your house went up dramatically, right? So what a lot of people have been doing was they would refinance their home, take out all that equity, and they would buy a condo pre-construction, because all they have to do is give the deposit to the developer and they don't have to worry about closing that property for 5 years, right? And that's how a lot of people built up a lot of wealth without needing to qualify for that strategy I just talked to you about, because you're literally buying time. You're getting into the real estate market today and not having to pay for it for another 5 years.
Daniel, we have another question.
Yeah.
Skipped it from Matthew. If you go up a little bit, he said, do you see it?
Oh, Matthew. Oh, okay. So back to your business for self-employed to be. Okay, so he says, if I open a business for 3 months and had pre-billed closing at the end of the year, what documents do I need? And how about previous tax docs? Okay, so with B lenders, they're not looking at your tax. Okay, so that's the beauty. And that's why they charge a little bit more money, because they don't care about what you reported. They care about what you're making today. Okay, so if you go to a typical TD Bank, Scotia Bank, BMO, RBC, those are AAA banks. They want to see your taxes, reported income, your line 150 on your notice of assessment. They want to see that for 2 years. With B lenders, all they really want to look at is your current bank statements, deposits. Are you making 5 grand a month? Are you making 10 grand a month? Are you making 15 grand a month? How are you earning your income? That's all they care about. They don't care what you report. And then what they want to see is, how are you making that money? Are you invoicing your clients? Are you getting email transfers? Are you getting credit card swipes? Like, how are you making that money? So that's all they really care about. It's all about revenue. So the mortgage amount will be $280,000. How can I make this work? So if you report like 60 grand, you're good to go. For B, yeah, you're good to go. Sorry, you don't need to report. You just got to show 60 grand approx of income for 3 months. It's better that you show it for 6 months, but 3 months can pass. Yeah, but if you want to get into the technical, get in contact with me, and then we can have a strategy call. I'll be happy to do that. So I've helped a lot of clients who they're new to Canada with no business. They just landed, and then right after 90 days, we got them into an investment property. So I told them what they had to set up, how to set that up, and then what we do is we do the calculations up front, and then it's up to the client to do that, and then we know we're going to close that deal. So it's all about setting the expectations up front so that you're not in the air, like not knowing, right? And I feel that when it comes to self-employed individuals, there's always that not knowing when it comes to tax time, right? How much should I report to the government? You should always report the least amount for your taxes. Write off everything. If you're in business, you should always find expenses for your business to expand your business, right? I would always spend more money on my business than paying the government the taxes. That's what I would do.
Yeah, we have another question from Tracy.
Yeah. Okay, so Tracy's asking, if the bank asks for a retrofit letter stating that the property was done to code, how do you suggest getting the construction code? I have no idea. I've never experienced this. So, yeah, I don't know, to be honest. I've never had experienced a bank asking for a retrofit letter. So, might be a new case for me to experience, but I could take a look. If you send me the letter, I could take a look and explore through my contacts, but off the top of my head, no, I don't have the answer for you.
Okay, we have another question. It's in French. I'm gonna translate. So she's asking, she wants to take out her equity.
Yeah.
But she's asking, should I do renovation first to increase more equity?
Okay, I'm so happy you asked this. Okay, if the goal is to renovate your home, right, and you want to refinance, always take the money first before you start renovations. Okay, and the reason why is when you're taking out a refinance, the bank will need to do an appraisal. And when the appraiser comes to your house, or right now due to COVID, they'll have you take photos of the house. If your house is in living condition, then the appraisal will come at value. So you're good. Then the bank's going to give you money, and now you can use the money to do whatever you got to do. If you start tearing down the place, then you ask the bank for a refinance, and then they're going to ask you for appraisal, and you're missing your sink, you're missing your kitchen, you're missing the washroom. That house is no longer in livable condition.
No, Daniel, I think she say it's like cosmetic, something simple, but making to increase the value before you go ask for the money.
Well, it depends, right? It depends how it's going to look during the appraisal, right?
It has to look nice.
Yeah, it really depends, because anything that you can see with your eyes will be picked up by their photos. So if the house looks beautiful, I know it's cosmetic, but we're talking about replacing the floors. If the appraiser's coming and there's no floors, I know you're getting new floors next week, but today the appraisal's happening. It's going to show in the report, and it's going to affect the value. Same thing with countertops. I had a client that she was doing a renovation while I was doing the refinance, and I told her, don't touch anything. And then she was getting a lot of pressure from the contractors, and she decided to listen to the contractors, and they tore down everything, and it affected the value dramatically. So even though it's cosmetic, you want to do the appraisal first, get the money approved, and then continue, because you can always get another appraisal after, right? When you increase the value, once the value's up, you can always do it again.
And can you go back to the bank and say, give me more money, or it will be too late?
Well, it depends what you're trying to do, right? Like,
no, she wants to take as much as she can.
Yeah, so it depends on the timing. So some clients want to refinance to renovate, and other clients already had cash or line of credit to renovate, and now they want to refinance to pay everything back. If you already have the money and you have access to the money, then finish your project and then refinance and then get the appraisal and pay everything off. But what I was trying to say is, if you don't have the money, if you don't have access to the money, you don't want to be caught in a situation on the appraisal. So yeah, if you have a Home Depot credit card, you got a line of credit, and you can renovate the house and make it nice and then refinance, yeah, do that. That's fine. But if you don't have the money and you're relying on refinance, make sure you get the refinance money first, and then.
Yeah, but Dania, if she take a credit, she used credit card to do renovations, it's not that going to affect her application for refinancing?
If she used credit cards
to do renovations?
No, because the refinance explanation, the reason that we're going to tell the bank that the reason why she needs the refinance is because she used the money from her credit cards to make it nice and pretty and to pay off the credit cards, right? And then what we can also do is we can show the bank when she bought the house, right? Mm-hmm. So we can say, hey, she bought the house last year, and here's the appraisal. This is what the house looked like last year, and this is what the price is, and this is what the house looks like today, and this is what the value is today. And yes, she has $50,000 of credit card debt, but this is why we need the money. So let's give her the money for this. So yeah, that's okay if it's through credit cards.
Perfect. Okay. Oh, we already passed 8. It's very interesting, the subject, because there are many information we don't have, and when you go to apply, surprise, you get rejected because just one little thing you didn't know.
You could get your mortgage canceled for any reason. Like, I had a client who quit her job right one day before closing. I can't make this stuff up, guys. I cannot make this up. I think she had a fight with her boss, and the boss already, I think 1 week ago, already gave the verbal confirmation to the bank. So they signed off saying, we're going to close this deal. And then I don't know what happened, but the bank did another confirmation the day before closing. And the employer said, no, that she's gone. She quit.
No.
And I can't make this up. Yeah. So even though you're approved for a mortgage, there's a lot of nuances. You don't want to change anything, right? When you get approved for a mortgage, don't buy a car. Yeah. Don't go to Leon's and buy furniture, even though it's like, don't pay for 3 years. Don't do that. Yeah. Okay. When you buy a property, when you get a mortgage, keep your stuff clean. After you close, when the bank transfers the money, you can do whatever you want. It doesn't matter. But before that, you want to be very, very careful. Don't miss payments. Don't go spend. Don't do anything crazy. I've seen a lot, like in the 15 years of being in finance, I've seen some crazy, crazy stuff. I've seen people who were not able to close deals because they went on vacation.
Oh,
we bought a house. Okay, see you guys. And they're in a different continent. They're in a different time zone. And the bank has questions, or they need to give documents, and they cannot provide. Some of them were able to provide. They had to call a family member back in Toronto. They had to tell them where their hidden key is so that they can go inside the house, tell them what the password for the alarm is, tell them where the laptop is, what the password to the laptop is, to give documents. I cannot even make this stuff up, right? So I always tell my clients, and I'm not here to scare you guys. I'm just sharing all the experiences and the nuances that I've seen where simple, straightforward straightforward deals go sideways. And it's due to very careless stuff, right? If you're going to go on vacation because you want to celebrate, you bought a house, congratulations. Get the keys, close the deal, and then go. Don't go before.
Yeah.
And if you got to go, let's say it's not a vacation. Let's say it's a business trip. You got to go. Make sure you tell your financier, your mortgage broker, your banker, you got to tell them, I'm going to be in, I don't know, Japan. I'm going to be in China, Russia. I don't care where you are. Tell them where you're going to be and what dates, because they need to also account for the time zone difference as well. Because the banks, the underwriters can call your banker at any time during 9 to 5. And if it's a different time zone where you are during your business trip, you're going to have a tough time, right? So you want to get all that stuff mitigated up front.
Yeah. And Daniel, the question I have for you is it good to pay off your mortgage? Is it good in eyes of lenders, or don't pay off your mortgage?
They don't care.
Huh?
They don't care.
They don't care?
They don't care. Because so banks know that you're always going to come back for money.
Okay.
When I was working in the bank, we're always selling 5-year fix. And the reason why we're selling 5-year fix is because they know statistically that 70% of individuals that take a 5-year fixed mortgage will break the contract at year 3. Mm-hmm. And over 80% will break it at year 4. And the penalties for breaking a mortgage can be $20,000, $30,000, $40,000, a lot of money. So this is the funnel. The banks will spend money on advertising and say, hey, we got the lowest rate. We got the lowest rate, because they suck you in, right? Because homeowners, they think about lowest rate. Okay, I'm going to sign in a 5-year fix. And then they know that you're going to break that mortgage in 3 years and pay a penalty, and they get all their money back. Okay. And that's why when I talk to my clients, I always do analysis. I ask them very specific questions. I look at their age, first of all, because someone who's 20 years old versus someone who's 60 years old have different goals and different time horizons. Number one, they have different priorities and living standards. Number two, I always ask them questions about their employment and income, right? I ask them questions like, do you foresee your income going up dramatically in the next 2-3 years? And the reason why I ask them that is because if you're making $100,000 today and 2 years from now, you get a $50,000 raise, your thinking is going to change, right? Like as humans, we live to our income, right? And sometimes we overlive to our income. We live beyond our income, right? So I'm always against, like most of my deals are 5-year variables, because from my questioning patterns that I ask my clients, it doesn't make sense for them to sign a 5-year fix. Because first of all, the variable rate is usually lower than a 5-year fix, number one. A common fear that most home buyers have is, what if the rates go up? That's the question that I always get. What if it goes up? But if you look at from the 90s and the 80s till today, the rates have gone down. So why are we not asking the questions, what if the rates go down? What if my property goes up? We're always looking at worst case scenarios, right? So that's another thing that I always ask clients. I'm like, do you foresee your income going up dramatically? It's yes or no, right? And then I ask them, what would you do if 2 years from now, your property increased $200,000? Because if you're buying a condo today at, let's say, $500,000, you're only buying a condo at $500,000 because of your financial position. That's it, right? That's it. Because if you have the ability to buy $1 million house, you would, right? Most people would, right? But the people who are buying $500,000 condos, because that's what they can afford. So I always ask them, tomorrow, If your property, your condo went up 200 grand, what would you do? Would you stay in this condo? 99% of the time, the answer is no. If I buy a condo for $500,000 and tomorrow it goes up to 7, they're like, I'm selling. I'm gonna buy my townhouse. I'm gonna buy my dream house, right? So then just from that questioning pattern, I already know that the 5-year fix is not the right product for you. So we should not be talking about the lowest 5-year fix. We should be talking about how do we get you into your dream house faster? How do we shrink that? Because let's look at numbers here. If we take a $500,000 condo and that condo goes up 200 grand to 700, when you sell a property, you got to pay real estate fees. And real estate fees are usually 5%, right? And everybody can accept that. So they go, oh, okay, well, I'm going to sell my property. I'm going to cash out 200,000 and I'll pay my realtor, I don't know, 40 grand. Okay, so that number is already in their mind. What happens next is another phenomenon. They go to the bank and they ask, what is my payout statement? What's my penalty? And when the bank says your penalty is 30 grand, they're like, oh, my penalty is 30 grand? So now everything changes. So they went from, oh my gosh, my condo went from 500 to 700. I want to buy a townhouse. I want to buy a house. Okay, they get excited. Okay, I got to pay my realtor 40 grand and everything's going to be great. I'm going to move into my next house. All of a sudden they look at the penalty. Oh my gosh, it's 30 grand. They're stuck in that condo. They're stuck, right? So that's why I always look at big picture. You want to look at 5 years out, 10 years out, because who freaking knew that a $500,000 detached home in Markham could be worth $2.5 million today? Who knew, right? So I think we have to always get out of that mindset of the worst case, because what if the best case happened and now you're stuck because of that contract? So that's one thing I want to mention.
We have another question.
Is it better to take a refinancing money or get a HELOC if money is needed after three to four? Okay, so here's my opinion with refis and HELOCs. Okay, so home equity line of credits, they're great, but it depends on when do you need the money. Home equity line of credit it's a line of credit, so the interest rate is usually higher than a mortgage. Okay, so if you're going to hold debt, like I mentioned, you always want the cheapest rate. If you're looking for flexibility and revolving money, then it doesn't matter. Okay, so if you're going to do a renovation that's going to take time and you need to recycle money, then I would get a HELOC. I would get a line of credit, because I can borrow $50,000 today. I could do my renovations, and then I could pay it down. And once I pay it down, I could reuse it. I can keep recycling the money. Okay. But if you already have all your budgets, you know exactly how much it's going to cost, and you're going to spend the money right now. You're not going to wait 3 months, 4 months, 5 months. You're going to spend the money right now. I would take a mortgage, because you're going to spend the money anyways. So you don't need to pay a higher rate, and you don't need to recycle that money anyway. So I would just put it into a mortgage. So it really depends on the timeline of when you need the money, how big your project is, and what your future goals. Like, is this your forever house? And are you disciplined? Because HELOCs, they turn your house into a credit card. So I've seen people make millions of dollars through a HELOC, and I've seen families get destroyed. So it's all about your personality too, because someone's like, oh my gosh, it's 300 grand. Okay, let's buy a Lamborghini. Let's go to the casino. Let's spin it on red. So I've seen both sides, right? I've seen people on both sides. They go, oh, I got 300 grand. Let's buy 3 properties, make good money. Great decision. Let's renovate. Great decision. But it can go the other way too. But But just to give that point, if you're going to hold debt, put it in a mortgage. If you're looking to recycle money, put it in a HELOC. So for me, a HELOC works better for me. Like I mentioned, I'm all about access to capital. I need access. I don't care. Like if Fannie says, Daniel, I'm going to give you $500,000 tomorrow at 30% interest, I'll say, I'll take it, because she's going to say it's 30% interest in a year.
Yeah.
So that means that I got to be able to find a deal that I can make my return shorter than a year. And now I know that I have access to $500,000. So to me, access to money is more important than how the money is set up.
All right. Okay.
Thank you, Gurvinder.
Okay. So, Daniel, is it the same to qualify for EROC and refinancing?
Which
one is easier?
It's just an extra step, because depending on the lender, what they'll do is they'll set up an amortization over 25 years.
I'm sorry, which one? I didn't.
A HELOC, home equity loan. Yeah. So some lenders, what they'll do is they will have you qualify for the mortgage component, and then they'll have you qualify for the HELOC component. So keep in mind that when you have a HELOC, it's additional risk to the bank, right? Because you can always recycle that money. When you borrow a mortgage, every payment, the mortgage is going down.
Yeah.
So when you get a mortgage, your property is going up, but your mortgage is going down. So that's why when you're coming up for a mortgage renewal, your bank's competitors are always like, switch your mortgage, we'll give you a low rate. The reason why they're going to do that is because the first bank took all the risk when you bought the house. 5 years later, your house went up in value, your mortgage went down. It's a completely free money deal for the bank, the competitor. So they're always like, hey, switch your bank. We'll pay for your lawyer fee. We'll pay for your appraisal fee. Don't worry, we'll come over, because there's no risk, right? And that's why they do that.
Okay. We have another question. She say her renewal is in November 22. And she said if she take equity now, is she going to how the penalty is calculated? Does it worth it, or it's better to wait?
It depends. So it depends on multiple factors.
Uh-huh.
So it depends. Are you in a variable mortgage? So if you're in a variable mortgage, great. And this is why I love variable, because if you're in a variable, you only pay 3 months interest. That's it. So depending on how much it is, to break that mortgage, it might be $2,000. Okay. If you're in a fixed mortgage, it might be 20 grand, 10 grand. I don't know. It's a lot more. Okay. And if you're in a fixed mortgage, what looked like a good rate 3 or 4 years ago looks expensive today. If you're in a variable mortgage, your rate went down. Okay, so that's another plug. But so the component number one is you have to find out if you're in a fixed mortgage or a variable. So variable mortgages, 3 months interest penalty, that's it. Fixed mortgages, it's more expensive. It's called interest rate differential. It's a fancy name, but it's just more money. That's basically it. So that's number one. You have to find out what component you're in. Number two, you want to take a look at what the current interest rate is and how much money you want to refinance for, because with the current rate climate, you could break your mortgage, you could take out more money, and you're still paying less than what you're currently paying right now. So there is an advantage to that. And the third component is, what are you doing with the money? So for me, if the bank tells me, Daniel, it's going to cost you $10,000 to break this mortgage, but I can take out 100 grand today, I'll do it right away, because I'm crazy. I'm not the average guy. Okay. The average person is going to say, I'm not going to pay the bank 10 grand. For me, when the bank says, hey, it's going to cost you $10,000 penalty, the way I look at it is I get access to $90,000 today. That's the way I look at it. And the cost for me to access 90 grand is 10 grand. So all I have to do is I got to find a deal that I can make 10 grand to cover the cost plus the additional interest, and that's it. So now I have to find a new deal. So it really depends on the purpose. So if you're planning to live in the house and refinance and pay a $10,000 penalty, and the reason why you're doing that is because you want to finish the basement, you want to increase the value, I would say that's a bad deal, because increasing the value of the property does not produce cash flow. So you're only paying the bank 10 grand to increase the value, but you will not see the profits unless you sell your home. So I would say that that's a bad deal. But if the purpose is, there's a deal right now that's, I don't know, you're gonna make $50,000 because it's under market value, and you can cash flow from day one, I would say do it right now. Do it. Pay the $10,000, take that 90 grand, shove it to the next deal, bring that deal to your account and write that interest off. And yeah, so guys, I really want to stress out, paying money, paying interest, there's nothing wrong with it. It depends on the purpose, and it depends how you structure your deals. I always focus on structuring deals. So yeah, I hope that answered your question. So terms, reason, and
okay. So you're saying a variable interest rate is better than pardon me?
Yeah, I love variable mortgages. Okay. Yeah, there's so many advantages because they're usually cheaper than fixed right off the bat, and a variable mortgage can turn into a fixed mortgage. Mm-hmm. Okay, a fixed mortgage cannot turn into a variable. Okay, so you have flexibility, and then we already know the statistics. 70% of people are going to break the mortgage at year 3. 80% will break it at year 4. So for me, I rather just take that chance, and I have flexibility. I always pay for options. I always pay for flexibility, and in the case of variable mortgages, you're actually paying less. Like right now, a variable mortgage at one of my banks is around 1.6%. Okay, but a 5-year fix is about 2.19 to 2.24. That's a big spread.
Yeah.
Now the question is, what if the rates go down? 2.19 might sound like a good deal right now, but if the variable rates go down 3 months from now to 1.2, oh my gosh, you're gonna feel that spread, right? So I like flexibility.
Mm-hmm. Is any way you can decrease your mortgage payment?
Refinance, expand it, amortize it to the max.
So if you have been with them for 5 years and you want to refinance, so you still have 25 years, can you
bring it to 30?
Oh, really?
Yeah, bring it to 30 years.
Oh, nice.
Yeah, that's how you bring down your payments.
Perfect.
I would do that all day. I don't believe in paying off my mortgage. Like, I don't believe in that. Like most of my competitors or whatever, they always say, hey, let's pay off your mortgage. I don't believe in that. I believe in access to capital and having somebody else pay for my mortgage, you know?
Perfect.
Like if you look at Grant Cardone has $1.8 billion of real estate assets.
Wow.
He's borrowing money.
Yeah.
Somebody else is paying for that money. Yeah. He didn't go, oh, let me buy not 1.8 billion, let me buy only 50 million and have them zero mortgage. He goes, no, let me just maximize the mortgage, write everything off, and cash flow, right?
Yeah.
So that's my mentality. That's my model. I have I'm $1 million in debt, guys. I'm a millionaire in the red.
As long as you buy assets, you don't buy a liability, you're good.
Yeah, I'm all in the red. And somebody asked me a question. They said, if you won the Lotto Max, if you won $60 million tomorrow, what would you do? I said, I will owe $120 million. I'll take the $60 million. I'll put it as a down payment. I'm going to borrow everything else and then have somebody else pay for it.
Okay, we have another question.
Yeah.
How to write off debt? Can you please clarify?
Yeah, absolutely. So you can't write off debt if it's your principal residence. Okay, so if you're the end user, you can't write it off. But if it's a rental property, just go to your accountant. All the interest that you're being charged, you can actually take that off because you're running a business now. So whatever interest you're paying on your mortgage, you can use the income from the rents to offset. And this is why I don't look at rates, because like, how is it wrong? Like, how can I ask somebody to pay me $2,000 a month, but I can't pay the bank to borrow the money to make this happen? Because at the end of the day, the guy who's paying me $2,000 a month, he's the one who's paying for the debt anyways. And whatever your mortgage payment is, there's an amortization schedule, and you're paying principal and interest. So every month, that tenant is covering your principal and your interest, and then you can offset your interest. So you can only do this on a rental. You can't do this on a primary residence. But yeah. I can't hear you.
Sorry. Can you tell us about your event next week? Because it's already 8:35.
Yeah, absolutely. Okay, so can I share my screen? I'll give.
Hold on. You have to be a co-host. Yeah, voila. Yeah, go ahead.
Okay. So here's my event, guys. Please follow me on social media. Just type in Daniel Char on Instagram, YouTube, Facebook, LinkedIn. Connect with me. I have a report. It's called Never Lose a Real Estate Deal Again. I'm going to go through all these numbers with you guys on my event. It's a 2-hour training. It's 7 o'clock till 9. So make sure you allot that time. And I'm going to go through most of the stuff that we spoke about today. So we're going to talk about, number one, why do most real estate investors fail? Okay. We're going to talk about why people fail. We're going to talk about the 3 channels of financing. So most people who can't get money, they're going through the wrong channels. Then you got to work with the right professionals. Okay. And then I'm going to show you guys how to structure your deal so that you never lose another deal again. Because a lot of times I get real estate investors that they bring me a deal. They're like, oh my God, Dan, I found a deal. I'm going to make $100,000. I'm going to cash flow, all this great stuff. And then they send me the deal to finance. And then when I ask them specific questions, the deal falls apart. And the reason why that is because most real estate investors, they look at real estate deals in their perspective. How much money can I make when I buy this property? But don't forget that your bank, your private lender, your financier, they're your business partner, okay? Because most of the time you're gonna put 20% down payment, and then the bank is gonna give you 80%. So the bank or the lender is gonna put 4 times the amount of money that you're gonna put in a deal. So it's great that you found a deal that you're gonna make 50 grand, 100 grand. That's great. But you gotta make sure that you structure the deal so that the deal makes sense for the guys who's giving you the money to make it all possible in the first place. So that's what I'm gonna be discussing at my event, March 18th, 7 o'clock. Go to my website, danielchar.com/register. You're gonna get my free report. And yeah, connect with me on social. I'm very excited. I thank you, Fanny, for this opportunity to share. And I really appreciate all the great questions that all of you have been asking me. And yeah, this was a lot of fun.
Yeah, it was very interesting. You have everybody got your contact, but if you have any question, then you can reach Daniel. you can let me know. I can put you in contact with him.
Yeah.
And Daniel, thank you so much for your time and for your good information. It's very, very interesting.
Thank
and
you.
I hope everybody enjoyed it. And thank you, and have a wonderful evening. And go make money, guys. Go make money. And
Money!
yes, so we can change the world.
All right, guys.
Thank you so much, and have a nice evening.
All right. Take care.
Bye.
Oh, thank you.